皆様こんにちは。本動画ではモルガン・スタンレーグローバルプレミアム株式オープンについて皆様からいただくことの多いご質問をもとに当ファンドが活用するグローバルフランチャイズ運用戦略の運用責任者であるウィリアム・ロック氏に2025年の運用状況等について解説していただきます。当ファンドは長期的に資産を着実に増やすことを目指し、高いブランド力、効率的なビジネス、潤沢なフリーキャッシュフローを兼ね備え、その循環を持続的な利益成長につなげているプレミアム企業の株式に投資しています。2025年のマザーファンドのパフォーマンスは、年前半の相場下落時には下値抵抗力を発揮し、市場対比で底堅い値動きとなった一方、年後半はデータやソフトウェアに関連する企業の株式が大きく下落したことなども影響し、市場と比較して出遅れる展開が続きました。動画では当ファンドの特徴、またパフォーマンスに影響を与えた要因や実際の投資行動についてご紹介しています。当ファンドについてご理解を深めていただける内容となっておりますので、ぜひ最後までご覧いただければ幸いです。
Hello, my name is William Locke. I'm head of the global franchise team. I've worked for Morgan Stanley Investment Management for 32 years and I've been head of the team for 20 years. I'd like to introduce you to Global Franchise, or to existing clients to reintroduce you to Global Franchise Global Premium. This is a product which has now been going for 30 years or so and has been run very consistently throughout that time. What we aim to do in Global Premium is to compound your money in the long term reasonably smoothly, and we do this by targeting absolute returns. We do not target benchmarks, and this means that sometimes we can look good against the market, sometimes we can look bad relatively, but we target the absolute returns. And the key thing to understand about our portfolio, it has a very clear signature. It is an asymmetric portfolio. That means is that compared to the market, when the markets go up a lot, we will very likely lag the market in relative terms. But what that also means is that when markets go down a lot, then we tend to significantly outperform those markets relatively, and we tend to be good at preserving capital. And if you look at the net benefit to you over the very long term, we aim to compound your money. Historically, for the last 10 years or so, we have compounded your money at about 10%, and that is more or less in line with our expectations which come from our process. We look to buy for the portfolio companies overall which can grow their revenues at about 4 or 5% and grow their earnings at about 10%, but at really high returns on operating capital employed. And if you do this consistently over time, you should make attractive absolute returns. The kind of companies we invest in, as I say, are companies which can make really high returns on their operating capital employed, and to grow consistently over that period of time. And most of our businesses aren't very cyclical. So the trick of the compounding behind the portfolio is you have sustainably high returns on capital employed for the very long term, and we analyse that on a bottom-up basis, and then you have some revenue growth on top of about 4 to 5%, and that should drive long-term compounding. And critically, we look at two additional things. We like companies to be well run so that they are protected when they allocate their capital and they're well managed by their management. And secondly, we like the returns to be protected by very good intangibles. So for example, for consumer staples companies, this could be brands, but for other companies, this could be very important networks, for example. So the last thing which we look to do is to buy these companies at a reasonable price. And if you do all these things, you should compound at attractive long-term returns. Our performance was very disappointing in 2025, both from an absolute perspective and also a relative perspective. And for this, I apologize to our clients. But the year started very well, and it proved that the portfolio does do what it's supposed to do, and its characteristics. So the start of 2025, there was doubt over the Magnificent Seven, and then President Trump announced tariffs against the rest of the world. And this was of great concern to the market, and the market went down very substantially. And in those circumstances, you would expect us to outperform. And we did, and we were down substantially less than the market, and we were about 9% relatively ahead of the market at the bottom of the market trough on the 8th of April 2025. From then, however, there was a massive rally as President Trump changed his mind on some of the tariffs, and therefore the market became more comfortable about both the American economy and also about the AI stocks, which had gone down as the Chinese DeepSeek model had caused great worry for investors in those stocks. So from April through to about August, there was a massive cyclical rally. It was a cyclical rally, but also AI stocks rallied, and then there was one of the biggest speculative rallies I have ever seen. And the net result of this is that the market's absolute returns went up, and our absolute returns went up, but we lagged the market. And that is exactly what I would expect. But then, this cyclical value and speculative rally very much continued, but then the market decided to sell off indiscriminately businesses which have data in them. And we own quite a lot of those businesses, and the market sold them off regardless of discrimination. So, for example, it treated a stock exchange, which I think will have almost no impact from AI, as the same as a software company, for example. And this hurt absolute performance in that our stocks were sold off, and then AI and cyclical companies continued to rally. So the bottom line of this meant that having started the year in a very promising way, we ended the year in a much more challenged position with only about 0% absolute returns, and we're about 21% behind the market. The last time quality stocks were out of favor this much was 30 years ago, and that corresponded with the internet bubble. But it's fair to say that is now the opportunity. Let's talk about some activities. We were able to buy 4 new companies, and I'd like to give you some examples of those. First of all, and I'd like to describe the opportunity here. I have previously said that the market sold off so-called victims of AI, which we believe have very strong defenses against AI and are in fact beneficiaries of AI. But the market all sold them off equally. And one of the companies which they sold off there is MSCI, whose largest business line is indices, basically. And indices cannot be replicated by AI. You may know that the Dow Jones Index has been around since at least 1917, so people have been free to try to replicate that business for the last 110 years, and they've found out that it's very difficult to do so. And AI won't change that, because what you have to do is to get many people simultaneously to adopt the business. And of course, it's business. We report against MSCI World Indices. That belongs to MSCI. So it's a very strong brand. And this was a classic example of when the market sold off, it didn't differentiate on these businesses, so we were able to get MSCI at what we thought to be a reasonable price. So that is taking advantage of the market selling indiscriminately, which is nice to do. We look at AI and we look at assessing the strengths of some of our data businesses against AI very, very carefully, and we also assess their opportunities. And sometimes this means we have to sell a stock. One of the stocks we sold is Accenture, which is a company which we've owned in the portfolio for at least 15 years and has been a very good investment over the years. But we reassessed Accenture because there are now a wider range of outcomes that is possible under AI. On the one hand, Accenture should be beneficiaries of the rollout of AI, because companies will have to employ companies like Accenture to change enough to roll out AI. On the other hand, AI could mean that there's a lot of deflation, pricing deflation, which Accenture is able to charge. And this is quite a wide range of outcomes. And we didn't have real conviction which way it could go. So we used the opportunity of having better alternatives to buy some of the names. So this is what we will always do. I think that there's a big opportunity now for global franchise, global premium, and this is a double opportunity. As a backdrop, markets look very high, and if you look at a 150-year perspective, markets have only been this high if you look at cyclically adjusted PE ratios of the S&P. They have only been this expensive 4 times in the last 150 years. And these 4 times always coincide with technological enthusiasm. And when markets get this high, this is historically a dangerous time to be invested in markets. And there are very few hiding places, but I believe that global franchise, global premium will be one of these hiding places because we are asymmetric compared to the market. If you look at the global premium, global franchise at the moment, this is a portfolio which is on consensus estimates we think can grow at about 8.5% for the next few years and get earnings growth of about 11%. And this is faster than the market. The MSCI World Indices companies consensus says they can grow at about 5.9% top line, and the rest of the about 12% or 13% earnings growth comes from margin expansion from already record margin levels. So what the index has to do is more difficult than what we have to do because we have higher top line growth. So that is growth, but if you then look at valuation, it's rare that the portfolio trades at a discount on free cash flow to the market. The second opportunity is relative. Global franchise, global premium, inexpensive markets tends to act like insurance in that when markets go down, we tend to go down a lot less than the market and our relative performance is much better. And one of the challenges for our approach has been, for the last 5 years, markets in US dollars have compounded at about 12.5%, which is much higher than historically is the case. And this has meant that our performance has been less good compared to that. But it does mean that markets are at a high. And I think it's relatively, the portfolio is now relatively very attractive, because if you believe that markets are high, and even if we can only guess at what could trigger markets to come down, has great companies and it's at a fair absolute price, at a price which should compound well over the long term, but relatively to the market, if there was problems in the market, it should do relatively very well. I said that markets look very high, and that means that markets have very high expectations. And Warren Buffett always used to say that he preferred low expectations compared to high expectations, because the problem is when high expectations don't come true. And right now you have high earnings multiples and high earnings. And the way to lose money is that either earnings go away or multiples go away, and if you want to lose a lot of money, then both go away. Now, we can all speculate on what triggers there could be, and I can speculate on some of them now, but the key point is I don't have to be right about the trigger. All I have to be right about is that we're in a period of high expectations, and those expectations may come true, and we may have more of the same for the next year or so. The problem is, though, if those expectations don't come true, because then markets could have a substantial fall. And remember too that at the moment, investors around the world all own the same thing. America is 72% of the world index, so it means that whatever the reason for any disappointment, they will all sell the same thing, which is the American market, which is more concentrated than it's ever been. So they will be selling regardless of price. Now, some potential triggers could be disappointment on AI. The market has very high expectations that the rollout of AI will transform corporate profitability. If it takes longer than the market expects, in that case the market could be very disappointed on AI performance. Secondly, you could have an American recession. We are not macroeconomists, but the market isn't priced for that. Thirdly, there could be an event outside America which causes all those investors who own America to sell America. And the point is, if they do that, everyone is selling the same thing at once. So these are some examples of the triggers which I can see which could cause a sell-off in the market. What I can't do is tell you about timing, but what I am saying is that historically we're at very high expectations, and that historically that's been a dangerous place for the market. I'd like to thank all our clients for being clients for the portfolio, and I'll remind everyone that we run the portfolio for the very long term, and if you buy, or if you're a client of Global Franchise, it's extremely important you understand what you have, in that we look for gradual overall compounding for the long term. We hold our companies for the long term, and historically that has got you to a good investment outcome. But if you want to hold some of the best compounders in the world, you have to let them compound, which means you have to invest for the long term.
ファンド設定来の基準価格等の推移はこちらです。ファンドの目的、特色、投資リスク、ファンドの費用等については画面を一時停止してご確認ください。